My name is Michael Gayed. I'm a member of the ETF think tank at Tidal Financial Group. We are a registered investment advisor that brings ETFs to market. So if any of you have the crazy idea of wanting to launch a fund, come to us. We'll tell you exactly how hard it is and also what the benefits are. And we work with great thought leaders like Mr. Brent Johnson. And I promised him I would not mention the dollar milkshake theory, but that only applies to me and not to Dan Weiskopf and David Chikansky. So we'll have everybody introduce themselves, and we will start off with Mr. Dan Weiskopf. Go ahead, Dan.
Mr. Dan Weiskopf here, otherwise known as the ETF professor, and yes, also a member of Tidal Financial Group, and as well as lead ETF strategist for the ETF think tank and co-PM of Block. Thanks very much, Brent, for joining us today. We're definitely going to shake it up, but I want to ask about the milkshake. David, you're up.
How's it going, everyone? David Chikansky here, fellow portfolio manager in the Tidal Financial Group. I focus on the Be Your Own Boss, BYOB, and inflation fighting IWIN ETF, IWIN. Today is CPI inflation day, and everyone's waiting for the Fed, so very timely to hear Brent Johnson's views on the markets. Brett, if you wouldn't, please introduce yourself to the team, and we'll jump right in.
Sure. So my name's Brent Johnson. I've got a firm called Santiago Capital, which is a registered investment advisor. We're registered with both the NFA and the SEC. We're basically a wealth management firm for high net worth individuals, managing separately managed accounts and private funds to kind of provide a holistic solution. And, I started years ago on Wall Street and just ended up deciding I wanted to be independent. And that's kind of where I am now.
All right, so we're doing this conversation just before mid-December, and I've been talking to a lot of advisors, and I've been calling this a Frankenstein year, in that it's a weird mix of 2021 and 2022. So 2021, small caps largely peaked around the GameStop surge. Large caps, FANGs took over. Everyone saw that as being the market, but most breadth deteriorated beneath the surface. 2022, you had stocks and bonds collapsing together in a very weird way, controlled implosion, given the sequence, risk on, risk off, not working. And then this year seems like a blend of the two, and the year's not over, right? Where small caps have done nothing, does not look like a new bull market. And for the most part, bonds really haven't gotten that bid, although credit spreads have stayed tight. So at the wealth management side, the RA side, the managing money part of this, talk to the audience how you've navigated this year. Has it been oddly challenging, easy? I gotta assume there's a lot more nuance than what the headlines would have you believe.
Well, it was a little challenging for me mainly, and I'll just hold my hand up right away and say I was too bearish this year. And I'm not an uber bear. I actually think the dollar. I know you guys think I know the dollar's going higher, but I actually think equities are going higher in the years ahead as well. So I'm not an uber bear, but I thought that there would be more challenges with equities this year than there was. And so for all of those who remained bullish, I tip my cap to them because they got it right. And it's so far has been a great year for equities. What I really find interesting on everything is that since this whole kind of rate hiking cycle kicked off, let's call it 2 years ago, or at the beginning of 2022, everything is basically right where it was 2 years ago, or within 10% of where it was 2 years ago. Equities, oil, gold, the dollar, copper's down a little bit, but you go across to all these different asset classes, and we've basically had this great reset because we're right back where we started, except for we reset interest rates from 0 to 5.5%, and now we're getting ready to start another year, and again we're kind of right where we were 2 years ago, but the interest rate environment has changed. So it's been a challenging. We've done okay. I mean, we've made money this year, but we certainly haven't made as much as the NASDAQ, and have been frustrated a little bit with our performance, but overall we're happy. Our mandate is probably a little different than a lot of people. A lot of my clients are very wealthy. They've done very well, and they've built up a nice nest egg. A lot of them are either in retirement or moving towards retirement. Their number one goal is protection of principal, and then after that, if we can make a nice return and beat the levels of inflation, that's great. And if we can get lucky and hit it out of the park every now and then, that's all the better. But so, from that perspective, the last 2 years, we've actually done pretty well because we weren't down very much last year. We did a very good job of protecting principal in 2022. We've made a little bit of money this year. And so here we are, we're getting ready to start another one. And I think it's a pretty challenging environment right now. And that's kind of a long, rambling answer to your question, but that's kind of where I think we're at.
Yeah, I mean, I think a lot of people within our community have been discussing basically like just wiping out the last 2 years of data and just continuing the dot plot from 2019, which would ensue we're in the midst of this like 15-year bull market that's like really long in the tooth. But 2019 was still not a great year. Like that's something I think also collectively a lot of people in our community were discussing how forward-looking capital market expectations were still very, very low. And the most logical explanation I've heard for why this time is different is that household and corporate balance sheets are strong and the government is broke. And in the supply-driven inflation cycle, the short rate just doesn't really move the needle. And with the surplus and balance sheets, the short rate actually moves GDP up, right?
Yeah.
Short rate is actually pushing GDP up with these strong balance sheets. So what do you see about that? Like, were they correct in attacking this through the short end of the curve?
Well, I kind of think that it's funny. I sent out a tweet on Friday night basically saying that I thought Powell has done a good job over the last 2 years. And I'm not a fan of central bankers. I wouldn't say he's done a great job over the life of his term, but I think over the last 2 years, I mean, I think you kind of have to give him credit. I don't know anybody that thought he could take interest rates from 0 to 5.5% over a 18-month period and have asset prices be within 10% of where they were and have unemployment be at its all-time low. But here we are, right? And so I kind of feel like, if you look back to 2008, and the reason I reference 2008 is most people that I think are invested now, at least that have, not totally young, are familiar with what a challenge 2008 was. And when Bernanke had to fight the deflationary effects in 2008, I think interest rates were at 3.5%. Well, Powell has almost twice that amount of cushion right now to fight something if and when that deflationary force shows up. And so, I kind of feel like the job is not done yet. I don't think he has pulled off the smooth landing. He's pulled off the smooth landing so far, but I still think that these lag effects are going to catch up. I think Powell thinks the lag effects are going to catch up. And I think that's why he has slowed the rate hikes. And he has said this many times, and I think people just are not listening to what he's actually saying. He when he was doing rate hikes, he was constantly saying, you should expect there to be pain. You should expect the unemployment rate to tick up. And there hasn't been a lot of pain, and the unemployment hasn't really ticked up. And now, so the last couple of meetings, he's talked about the lag effects. And because we were so aggressive early, we don't need to be as aggressive now, because as we move forward in time, those lag effects should do some of the work for us. And I think that's right. And so I think that at some point in the first half of 2024, now whether that starts tomorrow and lasts 6 weeks or whether it starts in January and lasts 6 months, I don't know. I'm not smart enough to know that. But I do think those lag effects are going to start to catch up. I think we are going to have a pullback in risk assets. I think volatility is not going to remain at 12 for the next year. And I think 2024 is going to be much more challenging than 2023.
So we started talking about markets, but of course, that's a broad statement. And everybody always seems to, in my mind, when they talk about markets, think about the S&P market. Like the equally weighted index is up like 9-10%.
Yeah.
That really should be everybody's benchmark in my judgment, because the Q's up 50%. Well, I mean, we all know it's like basically 5 stocks, 7 stocks. So, that's not necessarily a market of stocks. My question, and I think this is the biggest challenge, and nobody seems to frame it this way, is how much higher in terms of price do they think that the bond market will be in 2024? Higher in price, not, and it's like a weird way to tilt things, right? But everybody has to think about duration. And here we are, we're looking at what TLT, and it's down 2% or down 8% over a year. And that to me is the hardest thing to both adjust to for wealthy clients, as well as forecast on a go-forward basis, because nobody wants to forecast a recession.
Right. Well, and I think it's funny because for years, the big complaint was you have to go way out on the yield curve to get any kind of a yield. We're punishing savers. the little old ladies who get the pension, either, they've got to they have to buy a high yield bond in order to get any income to go buy groceries, right? And now you can get 5% for rolling, 2-month treasuries. And people are still pissed off at the Fed. And so, they're damned if they do and they're damned if they don't. And I think that the resetting of rates higher has frustrated everybody to a certain extent, because the people who wanted the rates to go higher thought that would also probably lead to equity prices coming down, and they haven't. And those who, thought that the interest rates would stay low and therefore loaded up on bonds, they've been frustrated because prices come down a lot. And I think there's enough frustration to go around for everybody. It is kind of funny to think that unemployment's at its low, volatility's at its low, markets are at their all-time highs, and everybody seems a little frustrated to me. Nobody seems totally happy, which is, I think that is a result of just the where we've gotten to, where markets are so manipulated at this point, right? And there really isn't free markets anymore. And so even if you hate politicians and you hate politics and you hate central bankers, you don't, unless you're just a buy and hold guy who's already made your decision that you buy your asset and you're just going to hold it for 5 or 10 years, you don't really have the choice of ignoring politics and ignoring monetary policy, because it plays such a huge role. And I think part of that, you guys probably know this even better than I do, with the change of the structure of the market with ETFs and passive investments, and, everything kind of moves in unison now. And, my friend Mike Green, who I think you guys know, has done a lot of work on this passive investing. And, it's really hard to turn the battleship. Once that trend gets going, the effects of passive kind of keep pushing it in that direction. And lately that's been up. But the problem is then when it turns down, it pushes it in that direction too. So these swings have gotten more violent and bigger. I mean, if we look at the graph of these markets, and like I said, they're flat over the last 2 years, but they're violently flat, because there was huge runs and huge drawdowns along the way. And so, again, I know I'm rambling here a little bit, but to me, it's like when you know what the central bankers are going to have to do to get out of this mess, they're going to have to debase fiat currency. But then when you also realize the change in the structure of the market and all the debt will lead to these terrifying drawdowns along the way, it's really hard to come up with a portfolio that you don't have to kind of constantly monitor. At least this is my opinion. You guys may disagree. And so, I think whereas 20 years ago, you could kind of just set your allocation and forget it. I personally don't think you can do that any longer. And so on the one hand, the market has become very not active because everybody's in passive. But on the other hand, I think you need to be active in order to protect from these drawdowns. So you've kind of got these dueling forces.
There's a lot of interesting things you said there, which I think are worth exploring. First of all, that point about we're back to where we are 2 years ago for most asset classes, that's nominal. I think part of that frustration,
that's fair. That's fair.
Right? And part of that frustration, I think, is that after inflation, the reality is, things are lower. Even if you look at the Russell 2000 index, which has been the sideways period, support resistance looks very tight on the nominal, but that's actually a real bear market still. Every single high after inflation is actually lower, right? It's just about perspective. And then the point on active, I think, is interesting. I always go back to the Brent and B. Barrow studies around asset allocation is the key determinant of portfolio performance. Yep. If you want to beat the market, you got to choose the right market at the right time. To beat the average, you got to choose the right average. The problem, I think, in a year like this is that you can't really beat the S&P when it's the only game in town, right? Because going back to equal weight and going back to even the international side, most things other than India really haven't performed, right, to any substantial extent. So I guess on that point about frustration, I don't argue the frustration is actually very justified, because it seems like the Fed has stuck the landing, the soft landing narrative, but there's so many other disconnects. Small caps not doing well because the zombie companies, yet credit spreads are tight. Bankruptcy filings are rising in the private economy, yet no credit event, right? Which has been my thesis toward the end of the year. And you alluded to correctly yourself, the lags are still yet to hit. Nobody knows exactly when. But that's where I think this gets to be challenging for anybody that's trying to put money to work, because you put money to work, everything looks rosy, and then suddenly the delay hits, right? And then suddenly that tail.
Well, I think also, I don't know exactly what the S&P is up. Is it up 15% for the year or 14, somewhere in there, right? I think if you were just invested in January and just invested in November, that's where all the return came from, for the most part. Because at the end of October, most markets were flat to down. Like the Russell was down, the Dow was down. I think the S&P was up 1 or 2%. Again, the NASDAQ was up, but that's because of 2 or 3 stocks.
The Russell broke the October low of last year.
Yeah, no, exactly.
I forgot about it in November, right?
But now 6 weeks later, everything's back to the highs for the year, and so that's the thing and that's kind of my point is the moves, the rapidity and the magnitude of the moves is very large, right? You don't typically get 10% up months on equities. It's usually like the stair step up and the elevator down. So it's not totally uncommon to get a down 10% month, but outside of some just raging bull market, you don't typically get a 10% up month. You can get big rallies if you're in a bear market because you get these short covering rallies, and you could kind of argue that's what we've seen. But I guess my point is for anybody it's on the one hand, I don't think you can just set your allocation and forget it, as I said earlier. But on the other hand, if you're trying to time anything, and unless you get it perfect, these moves are so big that you're kind of just getting cut to ribbons both directions. And so to me, I've been doing this for 25 years now. To me, it's far and away the most challenging environment that I've been involved with. I kind of get a chuckle when I talk to people and they feel really confident. And they think they have it figured out, whether they're into gold or Bitcoin or they're equity bulls or they're bond bulls or whatever it is. And if they have a high degree of confidence, I'm like, how will you have a high degree of confidence? I mean, I don't have a high degree of confidence. I've been doing this for 25 years, and I feel like I kind of have a fairly good handle on things, but I don't have a super high degree of confidence in this stuff. And so to me, probably the most important thing for me over the last couple of years is just being open-minded and not being too rigid, because I don't think this is a good time to be rigid in your thinking.
Oh my God. I love that you just said that, because I was talking to a financial advisor last week, and telling him a little bit about what we do in the tank from the standpoint of researching and, sharing ideas and stuff like that. And he's like, no, I'm good with my strategy. Like, what do you mean you're good with your strategy? He goes, no, I'm very, exactly what you said. I'm very confident. And to me, by the way, just put something into context, TLT over the last 2 years is down 36, 37. I mean, that's like,
I didn't mention that one.
Mind-boggling, right?
Yeah.
So, and what I wanted to ask you though was, we're talking 2 years. Is that a period of time that historically you've measured your performance? Do clients look out 2 years or 5 years or?
Oh, I'm pretty lucky, because if I have done anything good in my career, it's that I have managed expectations pretty well, and I've either convinced the clients that I have, or I've only taken on clients who agree with me that a 1 year time period is not the right time period to measure. Now, it's not that it's a bad time period, but you shouldn't be changing your strategy every 1 year just to chase whatever did good that last year. And so a 2 year time period is actually, we do kind of look at that. We don't typically just look at one. I think 2 is fair. I think 5 is even better. But at the same time, it's hard to wait 5 years to say, how are you doing? Everybody says they're a long-term investor until that next statement comes out, and then they go and look at it, right? So even though, we have kind of a long-term view, and again, my clients are great. Most of them have a long-term view as well. You do kind of mark your performance to market, and you would end up looking every month and every quarter. It's just human nature. But I think the key is not to let those monthly moves. On the one hand, you have to stay flexible, but you also can't just follow the latest thing every month. So it's kind of a delicate balance.
So Brent, we've got to get you more involved in the tank in terms of using our tools, at least being aware of our tools, because part of your your point's interesting, passive versus active. I totally agree with you. Got to be active with your strategy. How you use passive is important, right? And actually, I just wrote about that in this week's upcoming. But we'll get you signed up for the tools. Where does all this fit in your thinking with alternatives? Because to me, like the alternatives bucket should be 20% of everybody's portfolio, just because of lack of correlation.
Yeah. Well, so I have kind of two ways that I look at alternatives. So in general, this is a very generalized statement. I'm not a huge fan of alternatives right now, not because I don't think the performance will be there. The performance may vary. That may very well be the place to get alpha. But a lot of times in alternatives right now, you don't have very much liquidity, or at least you have a limited liquidity. And I think that having liquidity over the next couple of years may be the most important thing. And so I wouldn't say that we don't have allocation to alternatives, but we don't have as big as we used to.
I'm with you on that. You've got to have liquidity in this market always. Lockups in hedge funds are horrible and not really deserved. But ETFs, you have alternatives that are
That's
liquid, transparent. Well, I'm going to pick your brain.
So this is kind of how I have. Maybe if I give you kind of my overall thesis on how I develop a portfolio to begin with, that will help. So if you just look at charts of assets, they tend over long periods of time to go up and to the right. That's for a couple of reasons. One is because economies grow, demographics push demand higher. That's part of it. And then the other part of it is that fiat currency loses value over time. So you don't just want to sit in cash. You want to be invested. And again, if you look over the last 30, 40, 50 years, assets tend to go up and to the right. Now, there are periods of time where they go sideways for 10 years. But in general, assets go up and to the right. And if you study history, fiat currency loses value. So I want to be invested almost all the time in assets because assets go up and to the right. However, because we are where we are in this, in my opinion, this super debt cycle, and because debts around the world are so high, and because we are now in a world where it is fragmenting rather than coming together, and we have, to a certain extent, deglobalization rather than globalization, I don't think that liquidity and I don't think capital will flow as freely as it has. I don't think capital will flow as freely over the next 10 years as it has over the last 10 years. And I think that will cause, and as you probably know, I think the dollar is going higher. I think when the dollar goes higher versus other currencies, that creates the conditions where you can get these terrifying drawdowns along the way. So while we have an allocation to these assets that go up and to the right, we also have a volatility overlay, hedging strategy, however you want to describe that we will use to protect against drawdowns. With regard to the allocation itself, there's this theory called the permanent portfolio, and you guys have probably heard this, but and I don't do exactly this, but I just use this as a roadmap to kind of educate my clients. And basically, if you look over the last 50 years, if you would have just put your money 25% in either short-term fixed income or cash, 25% in equities, 25% in real estate, and 25% in commodities, gold, however you want to define that, you would have made money. I think it's 45 out of the last 50 years or something like that. The most you ever would have lost was 12%. And you would have almost kept up with the S&P 500. Not quite, but pretty close. But if you were invested in the S&P 500, again, you got a little bit higher return, but you lost money like 25% of the time. And you experienced 25 and 30% drawdowns during those times. And so my point is, what's that?
In the Harry Brown portfolio, there's typically like a deflationary bucket that is inflation.
No, exactly. And so
you mentioned a volatility hedge overlay. Is your volatility hedge overlay like essentially like a stop loss on some of these asset classes? So did you guys how did you avoid duration last year? You have these elderly focused benchmarks.
We had the opinion that it wouldn't surprise us if rates rose, and so we kept all of our fixed income 5 years or less. And so, it didn't do fantastic, but it wasn't down 25, 30% or whatever it was. And because we actually thought interest rates would we thought that the Fed was going to raise, and we thought that they would raise consistently, even if it crushed markets, which it did for the first 9 months. And then we all know what's happened over the last year. And so, but the volatility overlay, we will, like, as an example, right now, we think it's a time, we don't think this is a time to not have hedges on your equities. We've had this huge run up. You've got VIX at 12. The lag effects are going to start kicking in. We want to have exposure to equities in case we're wrong, like this year, but we also want to have some protection in case these lag effects do catch up. Yeah, I'll give you an example. So right now, equities are basically at their highs. You can go buy just slightly out of the money, maybe 1% out of the money put on the S&P out to June, and that will cost you somewhere around 2%. Okay? So let's pretend that I'm wrong and markets rally 10%, another 10, 15% between now and June. My 2% S&P puts will expire worthless and I'll be up 13% on my equities. I can live with that, right? But if I'm right and we get this lag effect catch up and equities are down 10 or 15% between now and March, those puts are going to be money very well spent, especially when you're buying with VIX at 12, right? If VIX was at 36, maybe that's not the best time to be buying puts. But in an environment like this where the put call ratio is very low, where the VIX is really low and equities are very high, I'm happy to spend some money hedging the area that I think is overbought. And I just use equities as an example, but there's times we've done that on gold. There's times we've done that on other asset classes. But that's kind of how we kind of subscribe to the permanent portfolio theory. We don't necessarily just do 25, 25, 25, 25, but we want exposure to those asset classes. And then we want to either, hedge those individual buckets when we think they need to be, or we're happy to go overweight when we think that's appropriate as well. And then as far as alternatives, we will do alternatives, but a lot of times we'll do them in a liquid fashion. So I'm going to give you an example. Now, the problem with saying something like this is people think you're doing this with your whole portfolio. This is not my whole portfolio. It's a tactical trade that we see right now that we think has the potential to make 15 or 20% over the next couple of months. So we just shorted cocoa. So cocoa is a commodity. It's at its like 3 or 4 year high. It's been the RSI is really high. The daily sentiment is really high. The stochastics have already rolled over, and the relative strength is starting to roll over. So we shorted that this morning. Now, could that go against us? Yeah, maybe it goes against us and we get stopped out for a small loss. But again, I can accept a 2 or 3% loss if I have the chance to make 20 or 30% the other way. And so so we will do a number of little tactical alternative type trades, sometimes to the long side, sometimes to the upside over the year that we think kind of helps add a little alpha to that general overall asset allocation.
Speaking of overbought, that brings us to the dollar. Okay, so I do want to get your thoughts on this. I think the dollar has surprised a lot of people. The narrative at the start of the year was, that's it. That was the secular top of the dollar, and bear market's here. You went sideways, then you had an unrelenting move higher, and now you're kind of, meandering, nothing too major. Currencies are notoriously mean reverting until there's a crisis, in which case there's a spike.
Yep.
How do you think through the dollar's movement this year? Did it make sense, and could it be more of a signal of what's to come?
I think it did make sense, and I'll tell you why. Because listen, the dollar kind of got ahead of itself last year, and this is what markets do. The reason the dollar did so well last year, 2022, was because Powell was aggressively hiking rates. And I know there's people out there said, yeah, but then they're not going to be able to afford that, and then they're going to have to print more money, and that's bad for the dollar. Okay, that eventually maybe that's true, but in the short term, as you're hiking rates, that makes your currency more attractive, because if you buy that currency, you get that higher yield for owning either short-term treasuries or money market funds or whatever it is. Those higher rates suck capital into that currency. And so as Powell's aggressively raising rates, and he keeps indicating that we're going to raise again and again and again, the market started front-running those rate. Sorry, my wife just started printing something. I hope that doesn't make too much noise. But as the market started front-running the expected hikes, just the way now the equity market is front-running expected cuts. And so in September of last year, the market or the dollar was at, I think, 113 or 114. And that's about a month later is when Powell started indicating, well, we're still going to hike. We're going to maintain tight monetary policy, but we're probably not going to hike at the same speed. So the expectations for the same speed started to come down. And that's when the dollar rolled over. And I think it made sense for the dollar to pull back kind of to where it's at now. The dollar's like around 104 right now. And I think that made sense to kind of pull back to the 105, 104 level. But in June, it pulled all the way back to 99, June or July. And to me, there went too far the other way. And here's the reason is, it's not that it wasn't appropriate for the dollar to pull back because rate hike expectations were falling in the U.S. To me, though, the people focus too much on the United States. And I understand why it is. It's the biggest market. The dollar's global reserve currency. Everybody sells to the United States. We're the dominant political power, all that stuff. It totally makes sense. But, things outside the United States can affect markets as well. And the idea that the Europe is going to out-hike the Fed is, in my opinion, wrong. And that the Japan is going to out-hike the Fed is wrong. And so I felt like over the summer, it got way too far weak, and now it's come back. To me, it's pretty appropriate where it is right now. But I will say, I think the market in general does not appreciate the speed with which the dollar could just rocket higher, especially if these rate cuts that now everybody expects don't materialize. I think, what are they expecting? 2 cuts by June now? Or 1.5 cuts is fully priced in or something? I'm not saying that can't happen, but let's say we get to March and he cuts. Okay, well, now what? The market's already priced in a cut. Is he gonna be super dovish in March? In my opinion, the only way that they become super dovish is if markets sell off, volatility rises, and unemployment starts to tick up. So but if those things are happening, the dollar's probably going higher. In other words, you're not going to have, the S&P is not going to fall 20% and the VIX go to 25 and the dollar be falling. It doesn't work that way. The reason that the S&P would be falling and the reason the VIX would be spiking is because the dollar's going higher. I can show you a chart going out over the last 25 years. Every time there is economic volatility or some kind of a slowdown or some kind of a crisis, the dollar goes higher, because that's the way the system is designed. And so I think I think that the market is mispricing the potential for the dollar to move strongly higher in 2024. Now, that doesn't mean it will happen. I just think it's mispriced. The probability, I think, is mispriced.
So I going back to the point about hedges, if you're going to own the dollar now, you're owning it as a risk-off hedge, right? I always go back to this kind of 4 main risk-off plays: utilities, the dollar, gold, and long-duration treasuries. Long-duration treasuries have been the worst out of those 4. The dollar has been the best. Gold now getting some traction, but it seems like you still think the dollar would be probably the better relative risk-off hedge.
Well, I do, and I'll tell you why. Because, again, because of markets are where they are, and because of the structure of markets, this kind of goes back to what we were talking about with passive investing and the way things have changed. And, the way, humans don't even make decisions anymore. It's all algorithms or code or, formulas. You can get into these liquidating type markets very quickly. And in those liquidating type markets, everything gets sold. It doesn't matter what they are. Even treasuries get sold in that environment. If you go back to March of 2020, everything went down except for the dollar, right? And so I think having some exposure to the dollar or some kind of a trade that benefits when the dollar goes higher, I think is the way to play it. Just buying the DXY, and it goes up 5%, that doesn't do a whole lot. But the DXY going up 5% probably mean other assets are moving 10, 15, 20%. And if you can be on the right side of those, even with a small percent of your portfolio, it has the ability to kind of hedge that volatility.
This is an area of the market, I think, that most financial advisors are afraid to talk about. And I think it's so critical. As an example, our friends at X-Tracker have an ETF that's up 32%. That's hedged Japan, right, over 2 years, versus EWJ, which is down like 5. Yeah, I mean that dispersion is massive.
Yeah,
and somebody got it right, maybe somebody else got it wrong. Along those lines, though, with your theses, so walk us through some of the things that you use in your investment strategies. I should know, but are you like an ETF guy or are you a stock jockey?
It's a little of both, to be honest. Our equity portfolio is predominantly made up of ETFs, but then I should say it's actually about maybe 60 to 70% ETFs and then 30% individual equities. That's on the equity side. On the fixed income side, it's predominantly ETFs, but then we also have some individual bonds. And then, gold, my clients, we own some physical outside of brokerage accounts, outside of kind of the banking system. But then we also will trade tactically, gold ETFs and gold exposure through that. But I think ETFs are fantastic. I think they're a great, especially when you're entering a market. So as an example, let's say you've got cash on the sidelines because you've been waiting for a liquidity event. And then you get the big sell-off like either last September or, March of 2020, and you just want to get exposure quick because you see the opportunity. You can go buy an ETF and you can get broad exposure very quickly as opposed to going and buying 25 different stocks or 15 different stocks. And then if you decide you want to keep that position, you can either just keep it and ride it, or you can diversify out of that into your individual positions over time. And also similarly, for hedging, I like using, a lot of times when we buy hedges, we don't typically hedge our individual stock positions. We'll just buy puts on an index, whether it's the Dow or the S&P or the NASDAQ or whatever it is. And so I think ETFs are a fantastic way to get exposure, and especially for kind of these alternative markets that you're talking about as well. When they first came out 10 years ago, they weren't very efficient, and they were very expensive, and the roll risk and all this kind of stuff associated with commodity ETFs wasn't great. But they've gotten a lot better over the last 10 years. And now I think there's a lot more choices, there's a lot more competition, and typically when competition comes in, prices come down, and then they get better. And I think the ETF market has gotten a lot better, and I think it's a great way to get exposure to markets.
I'm gonna push Weisskopf's question a little bit further and ask for more examples for dollar-centric strong investments. Is this like small caps with revenue in the U.S.? Is this like EM debt denominated in U.S. dollar?
No. Well, as an example, if I was going to build an ETF and I was going to, or if I was going to build a portfolio using ETFs and I wanted to express my view of the world, I would probably buy, we use a couple different ones, but a short-term treasury ETF, or, either my cash or my short-term fixed income exposure. I'd buy, just the indexes for, the long exposure. I do not have any exposure to small cap. I think in the years ahead that you're going to have the best performing equities are going to be big blue chip U.S. dividend paying stocks. And so, we own a bunch of individual names, but, whether you just buy the DIA or some kind of a ETF that also pays a dividend, I think that has the big companies. I think that would be a good place to go. I actually think technology is going to do very well in the years ahead, but I think it needs to have a correction before that. I think we need to get some of the froth out of there. We need to kind of trim the exuberance, right? But if we get a hard sell-off in technology sometime over the next 6 months, I would be a buyer of the big technology names, because again, I think that's where the majority of the growth in the world is going to come from. I don't think there's going to be a lot of growth in the world, but I think the growth that does exist will be in large U.S. technology names. Some other exposure, gold. We always own gold, but we've had hedges on gold from time to time. We didn't hedge it this last time. Where it spiked to 2,100 a couple weeks ago. Trying to think some of the other exposures that we have. But then we don't just trade ETFs. We trade. We have a private fund where it's basically a black swan fund. And, it has a number of tail risk trades in there, but we typically don't do that with the ETFs. We typically use futures and different over-the-counter products for that.
Weisskopf, go.
Yeah. So playing off of David's comment about governments being bankrupt, which do you worry more about? I guess you kind of answered the question, but the U.S. problem with their debt or China's problem with their debt, and how do they play off each other? Because it's kind of scary.
Well, so this is very central to my overall thesis. And where my debates typically come in is when people will, I think they correctly identify the issues. They correctly say this is a problem. But then I think in many ways they come to the wrong conclusion. And the reason, and I know many people disagree with me, perhaps some of you guys do as well, but the reason is that markets trade relative to each other. If you are an individual and you look around the world and you say, wow, the whole world is horrible, I don't want to invest. I'm just going to sell everything. I'm going to buy some gold. I'm going to buy some Bitcoin. And I'm going to go away for 10 years and come back. That's fine. You as an individual can do that. Big institutions can't do that. The people who are allocating the capital on a large scale can't do that. They have to put their money somewhere. And as a result, markets become a relative game. And despite all the problems that the U.S. has, and there are many, I still think that we are the best relative place for capital to go. Now, I think if you just analyze the United States in a vacuum, the only possible conclusion you can come to is that it's a disaster waiting to happen, and it is not going to end well. And so for anybody who has that view, I don't really argue with them too hard, other than maybe the timing, and that is because let's use the higher interest rates as an example. I don't know how many times we've seen these charts going around this year that says, the interest expense is now the second highest line item for the government, and it's not going to be long till it's the number one line item. And this is a disaster for the United States. And again, it is bad, but higher rates are a disaster for China as well. This is why China's having so many deflationary pressures. It's a disaster for Europe as well. It's a disaster for everybody. Because the whole world uses dollars, either for funding through the euro dollar market or for sales and invoicing through their products or selling to the United States, the whole world is dependent upon dollars. And as interest rates go higher, that doesn't just affect the U.S. and USD, it affects all the dollar funding in the euro dollar market. Most people know that the United States owes over 30 trillion now. What most people don't know is the rest of the world owes over 30 trillion in US dollars, right? And so we can print the US dollars and the rest of the world cannot. Now, I know that people say, well, that's going to kill the dollar. Yes, eventually it will. But if you were, let's say you're playing poker at a table and you're playing against two other guys and one of them has a chip printer under his chair and the other one doesn't have a chip printer under his chair, which one are you going to feel better betting against? I don't want to bet against the guy that can print the chips, and so on a relative basis, I think the U.S. can, is the budget a problem? Absolutely. Is the debt a problem? Sure it is. But it's a bigger problem for the rest of the world than it is for the United States. Problems in the United States end up being problems for the rest of the world. And so I kind of, and again, I know I'm rambling a little bit, but this kind of helps. I think this kind of helps set up the way I see things is that I see four possibilities in the years ahead. One is that for some reason we discover some new technology, some new energy source, and we actually are able to grow out of this super debt cycle and all this debt that we have. I think that's a very low probability, but it's a probability. So everybody grows together, in which case I'm fine being invested in the United States. The other option is that the whole world goes down together, just a global disaster, 2008 type scenario, in which case I don't think it's really better anywhere else. And so I'm happy just being in the United States, investing in the United States. The third possibility is that the U.S. does okay and the rest of the world does horribly, kind of like this year, in which case, I'm happy being in the United States. The fourth possibility is that the rest of the world does really well and the United States does poorly. Now, while that is a possibility, that last one, I think it is such a low probability. I don't feel like I need to bet very highly on it. Because the United States is either the number one or number two biggest customer for everybody else in the rest of the world. If the U.S. goes into some massive recession as a result of their debt problems or their interest rates or whatever it is, social problems, then we're not going to be able to buy all their goods. And those economies are then going to struggle as well. And they have massive amounts of debt to service as well. So if their revenue falls, how are they going to serve all that debt that they took on when everything was good? And so this idea that the United States is going to end up this heaping pile of ashes and the rest of the world is going to grow while we're suffering, to me, it just doesn't line up with reality and the way the global economy actually works. So as a result, because I think those are the four choices, and because I think the most likely scenario, or in the three most likely scenarios, I think the U.S. outperforms. Almost all of our assets are focused in the United States right now.
So, I mean, I don't disagree that from an economic perspective, like the U.S. could very well outperform over the next 2 years. We still are in this moment of super stretched valuations with super high earnings expectations baked into the S&P 500 numbers and record low, valuations in the international markets. And we all know, especially from the last couple of years, like markets and the economy are two separate things. And it just feels like you have a little bit more of a cushion there. I think the Japanese market this year shows us that you don't really need a quality balance sheet to have an equity rally, right?
Oh, yeah, absolutely not.
A pretty strong equity market. And then, so I'm going to ask you about that. And also your frustration, your bias, everyone has this FOMO, but weren't you in a decade of worrying about 2 to 3.5% distributions on client assets for success? Now you're in the 3 to 4.5%, 5% distribution world. And doesn't that make financial planners' life just 1,000 times easier?
I'm not sure I understand that last part of the question.
So in this interest rate environment, retired clients can distribute a much larger percentage and withhold their asset value over time. So it just feels like those are the people who should be celebrating that, they could do a 5% distribution rate and not a 3%.
Well, I actually do agree with that. And this is what I'll say, higher rates, until you hit the wall, higher rates are great. More money gets deposited into client accounts. They can, they don't have to go so far out on the yield curve to get a return. Again, you can get 5% for rolling, T-bills, basically. Maybe not quite T-bills, but, 2 year, you can, or you can just keep rolling these things and you get 5%. I remember it wasn't that long ago, you had to buy a junk bond to get 5%. And so I do agree that makes things easier. And it gives you the opportunity. If you are so sure of your investment, then go do it. But if you're not sure and you want to have some dry powder on the sideline in case something crazy happens, then it's great to be able to buy some short-term T-bills, get 5% and just sit there and wait. It gives you such great optionality that I just can't figure out why more people don't do it. Maybe there are a lot of people doing it. I know I'm doing it. And so I think that's a great way to do it. Going back to your question regarding emerging markets versus the United States. Listen, if we do not have I'm in the camp that we will have a correction in 2024. It could be a severe one. Maybe it won't be, but I think we will have one. If I'm wrong and equity markets kind of hold up, it's very possible that EM outperforms the United States. But again, if the S&P's up 12 and EM's up 15, I don't really care. I don't need to take all the additional risk of being in EM for that extra 3%. So to me, it's not worth it. Now, if you told me that EM was going to go up 37% and the US was going to be up 8%, now that's pretty significant. I don't think that's likely. And listen, if that turns out to be the case, I'll hold up my hand and say, you know what, I got that really wrong. But to me, it's not worth the incremental risk of being exposed to those markets, because we will at some point have a reckoning with this debt. And when that happens, I think EM will get crushed. And so I want to stay away from it.
So given your bearishness, maybe that's too strong a word. Feel free to correct me. I got to ask you, on two levels. Bitcoin, where do you stand on it? And if you are not a fan, how do you distinguish between it as a commodity versus blockchain?
So it's funny because I kind of get accused of being this massive Bitcoin bear a lot. And I'm really not. It's just that unless you are a maxi, you're considered a bear, right? Unless you are all in on Bitcoin, that's not enough. It's never enough. You should like sell your house and lever up and buy Bitcoin. I actually really like Bitcoin from a philosophical perspective, and I love it from a speculation perspective because I think it's probably the purest play on global liquidity. Like if you think we're going to have, go back to era of low rates and high QE, I think Bitcoin will do fantastic in that environment. But I think if we get into another, if we have another one of these deflationary sell-offs or liquidating type markets, I expect Bitcoin to get, liquidated in that type of a market as well. I have clients that own it. I've helped them buy it. To me, it makes sense as a small percent of a portfolio. I'm not somebody who thinks you should have 50% of your money in Bitcoin. But I do, the reason that I've kind of gotten labeled a bear on it is because a lot of people in the Bitcoin community think that it's just a given that it's going to win, and that there is nothing that the government can do to stop it. And it's just stack over time. It will go higher, and governments will end up having to adopt it. And to me, this is just to fundamentally misunderstand the nature of government. And governments, while it might be good for an individual, governments do not want a currency that they cannot control. And governments have a lot of power. And these people say that the governments are out of bullets and there's nothing else they can do. Like, to me, you're crazy. There's a lot of things they can do. And I think when they do that, it will be a hindrance to price. Now, does that mean it's going to zero? No. Does it mean it's going away? I don't think it's going away. But it could certainly go down. And so, I'm not opposed to holding some Bitcoin as either an alpha play or some kind of a hedge against global volatility, or just a pure speculation on things going higher, monetary debasement. I have no problem with it at all, but I'm just not somebody who thinks it's an automatic winner that you just buy it and, don't have to worry about it.
I'm going to disagree slightly because isn't the irony that these countries or these dominant world powers would actually have to work in unison together to actually do that? Otherwise, you're just playing whack-a-mole one at a time. And that, in my opinion, is like what will stop it. Like one big nation could always obviously come down on it, but like someone else would always view that as an opportunity unless we actually completely coordinated as one, which has just never happened in the history of mankind.
Other than some very small fringe countries here or there, which I cannot rule out them adopting Bitcoin or using Bitcoin, I cannot see any developed country adopting Bitcoin and using that as their primary currency. Here's the thing. Bitcoin...
Adopting or blocking use, right? That's...
I think it's highly unlikely. Again, I can't rule it out. Maybe they will try. But the thing is that Bitcoin is incredibly political. Now, all you got to do is read the first paragraph of the white paper. It is fundamentally in opposition to the state. All you got to do is read through it. If Bitcoin does what the Bitcoin advocates think it will do, it will ultimately come into conflict with the state. And when that happens, the state will not back down. Now, that doesn't mean that the state will win. Maybe Bitcoin will win, but there will be a battle. And I just think the governments have more ability to battle it than many of the maxis seem to think that they do. And so, again, I'm not opposed to having exposure to it. But if governments wanted a currency that they couldn't control, they would have kept a gold standard. But they don't want a currency that they can't control. So if you're a Bitcoin advocate, make a list of all the benefits that you see of owning Bitcoin. Same with gold. Make a list of all the reasons you want to own gold. Now you have a very good list of all the reasons that the governments hate it, because they are on the opposite side of the table of the individual.
I was going to say that's your decimal points on the balance sheet.
Yeah, good be.
I think that's a good place to wrap this show up. Everybody, please make sure you support Mr. Brent Johnson and the dollar milkshake theory, which we didn't really talk too much about, by following him on social media This will be a podcast as part of the ETF think tank's ongoing efforts to increase its visibility and content. And thank you, everybody, for joining. Thank you, Brent. You are, as always, the man.
I appreciate you guys having me on, and look forward to talking to you again.
Thank you, everybody. Cheers, everybody.